Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing BTI stock by analyzing their financial statements and dissecting their financial ratios, so we're going to determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 72 billion market cap. They're trading at $29 a share, and they have 2.5 billion shares outstanding. British American Tobacco manufactures and sells cigarettes, tobacco, and other nicotine products. They have operations in 180 countries, and their cigarette brands include Dunhill, Kent, Lucky Strike, Pall Mall, and Rothmans. They also sell alternative nicotine products like Velo, Vuse, and Glow. Those three companies sell non-combustible products. Non-combustible means there's no need for a flame. Like a regular cigarette is combustible because you need a flame or fire. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. All their financials are in British pounds. I converted the numbers to US dollars since we're looking at the ticker that trades in the US. They generate a lot of free cash flow, the most in 2023, $12.5 billion. Which is more than enough to pay the dividend of $7.4 billion. Look how high their yield is, over 10%. That's a pretty safe and secure dividend payment because they've been paying it for decades now, and they have plenty of free cash flow to afford it. Really high margins. They converted 37% of their revenue into free cash flow in 2023. It was 35% before that. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was between $8 billion and $8.5 billion. Before 2023. Then in 2023 it was a big negative due to large impairments. And you know it has to be due to a large write-down because they generate a lot of free cash flow that year. So it's a non-cash expense. Revenue is the sales for the company, and that was highest in 2022, $34 billion. It was a little under $34 billion in 2023. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows, past year 4, that's $96 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $97 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of $39. They're trading at $29, so they're trading at a 25% discount. It's a strong buy according to the model. Most tobacco companies trade at a pretty big discount. And I kind of limited their future growth, and it still seems pretty undervalued. There are 12 companies in the same industry as BTI, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They only spent $700 million in CapEx, a little more than half of Philip Morris. Debt to equity ratio 0.8. For every dollar of equity, they have 80 cents of debt. The reason Philip Morris and Mo are NA is because they have negative equity. They pay the highest dividend, 10.2%. Mo also pays a big dividend. They generate the most free cash flow by a pretty good margin, $12.5 billion. Their market cap is half PM. They have a really good price to book. They're trading at 1x book value. This means their book value, their equity is equal to their market cap. We can't look at their PE. They have negative earnings. Look at their price to free cash flow, under 6. They're trading at 6x free cash flow. That means their market cap is 6 times their free cash flow, which is an amazing multiple. They're trading at 2x revenue. They generate $34 billion of revenue, a little behind PM, and their 5-year annual revenue growth rate is 2%. The average is 9%, median 4%. The Chinese e-vape company RLX is growing at 63%. Their first stock split was 31 years ago in 1993, a 2-for-1. Then 7 years ago, a 2-for-1. If you put $10,000 into this company 10 years ago, you would not be happy at $9,200 today. The stock has performed poorly. At one point, you would have been up about 25-30%. Then you would have been down 25-30%. So it's a true roller coaster ride. Up, down, up, down, up, down. Let's take a look at their 2023 results. They report their financials in British pounds. Revenue of 27 billion pounds. 1 pound is equivalent to 1.24 US dollars. So 10 billion pounds is 12.4 billion US dollars. So 27.3 billion pounds is close to 34 billion US dollars. And their revenue is down 1.3% from 2022. New category revenue, vapes and things like that, up 16% to 3.4 billion pounds. In their new category, they're profitable. In 2023, they had a net profit. And they had a loss before that. And they projected a net profit by 2025, so they're 2 years ahead of schedule. The main reason for that is improved trade margins, reduced COGS, and marketing optimization. Their brands, Views and Velo, are already profitable. Here's their Newport volume by month. Look how much it's grown since January 2023. It looks like it almost doubled. December 2023 was their best month. Same thing with Lucky Strike, their best month, December 2023. But the growth is not as significant as Newport. They launched Veo in September 2023, and it's growing a lot in a bunch of countries: Poland, Czech Republic, Romania, Germany, and Greece. They were first to launch in these 11 countries down here. A really wide reach. They touch almost every country in the world. I think they sell in 180 countries. The whole world is 195 countries. If you live in the UK, do you consider the UK a country? Because I consider the UK a country, but I know people in the UK consider England a country, and some people consider Scotland a country, or even Wales, and some people think of Northern Ireland as a country. But they're not countries. The UK is a country, and part of the UK is England, Scotland, Wales, and Northern Ireland. But I'm just curious of your point of view if you live in the UK. And this is how they allocate their free cash flow. For dividends in 2019, $4.6 billion. That grew to $5.1 billion. And buybacks, they only spent $2 billion in 2022. The rest of their money they use to grow their business or pay down debt. And look how much their free cash flow grows each year, from $6.5 billion to $8.4 billion. Their net debt to adjusted EBITDA is improving. It was 3.5, now it's 2.6. The goal is between 2 and 3, and they're right in the heart of that goal. Their new category revenue growth is growing at a 28% CAGR. That's compound annual growth rate, from 1.3 billion to 3.3 billion. Modern oral is their biggest growth, 39%. Then vapor, 27%. They now sell smokeless tobacco in 24 markets, up 50% from last year. Their product Views is 36% of the clear vapor market. Glow is 18% of the heated products market. It was 19% last year. And they have 4% of the combustibles and HP market. Velo is 8.6% of the modern oral market. Their combustible market is down 6.4% in the US, but it's up in other countries, so overall it's up a little bit. Here's a nice overview of the macroeconomy. Inflation 3.4%, which is down a lot from 2022 of 6.5%. Average hourly earnings up 0.6%. Personal savings 4.6%. Gas prices are down from $4 to $3.50. And consumer sentiment is up from 60 to 70. Premium cigarette sales are declining in the US. It was 55% at the end of 2022, now it's 54%. But this company's volume of the US market has grown a little bit, from 43.6% to 44.8%. Here they talk about that big impairment, the reason they had negative net income. It was mainly from $23 billion related to their US brands. This article talks about the brands that took an impairment. Their Camel brand of cigarettes and American Spirit had an impairment charge of $31.5 billion due to struggling sales in the US. They have amazing operating margins. It grew from 44.9% to 45.5%. Nearly half their revenue is converted into operating income. 30% is really good, and they're close to 50%. Most of their volume is FMC, factory-made cigarettes, the combustible cigarettes, but they're projecting that to decline quite a bit into 2035. And their other three segments are projected to grow over the next 10 plus years. In 2023, they sold over 500 billion cigarettes, which is less than 2022, 580 billion. Revenue was under 27 billion in 2022, now over 27 billion in 2023. And they're growing their customer base, 21 million to 24 million. They control 39% of the market in Australia, 85% in Bangladesh, almost 100% in Chile. Germany is a pretty wealthy country, 21% of Germany. 1/3 of the market in the US, 8% in the UK. Let's look at a stock on Simply Wall Street. Its last price, $29.64 billion market cap, up 1.5% in the past week, down 20% in the past year. Let's see what they say about the company. BTI engages in the provision of tobacco and nicotine products to consumers worldwide. It offers vapor, heated, and modern oral nicotine products, combustible cigarettes, and traditional oral products, such as snus and moist snuff. It offers its products under the Views, Glow, Velo, Grizzly, Kodiak, Dunhill, Kent, Lucky Strike, Pall Mall, Rothmans, Camel, Natural American Spirit, Newport, Vogue, Viceroy, Cool, Peter Stuyvesant, Craven A, State Express 555, and Shuangxi brands. It also distributes its products to retail outlets. BTI was founded in 1902, based in London, UK. Here's a stock price since '98. Its lowest point ever was in the beginning of 2000, 403. So if you bought the stock for 403, your dividend yield would be like 90%. Then it ran up to almost $40 in 2007, dropped to the low 20s in 2009, an amazing bull run over the next 8 years to its highest point ever, 73 in 2017. Then over the next 2 years, it dropped about 60% to the low 30s. It came up, but then COVID came and it went down to, it looks like, the high 20s. It did get close to 50 in the beginning of 2022, but it's almost cut in half since then, so it could be a great buying opportunity. Simply Wall Street is really bullish on this one. They're at $59 a share. They say it's 51% undervalued. The revenue forecast for 2024 is £27 billion, 2025 $28 billion, 2026 $29 billion. £29 billion equals $36 billion US dollars. Or £29 billion is really, really heavy. The free cash flow forecast looks pretty flat, $8.2 billion in 24, $8.5 billion, then $8.3 billion. Their revenue has grown a lot since 2013. It was $15 billion. And then over the next 10 years, it almost doubled to over $28 billion in 2023. It's currently $27 billion in the trailing 12 months. They had $12 billion of debt in 2013. They added a bunch of debt in 2017, close to $50 billion. It's coming down a little, under $40 billion currently. But their equity is usually higher than their debt. Currently over $50 billion of equity. And they don't keep that much cash on their balance sheet, $5.3 billion of cash. The CEO's salary was £300,000 in 2019, up to $1.1 million in 2023. Total compensation, $4.6 million. Tenure as CEO, almost 10 years. 67% of the company is held by institutions, 22% by the general public, and 11% by private companies. Their biggest shareholder is the LA company Capital Research. The billionaire Kenneth Dart, his company owns 10.5%. Then you have BlackRock at 8.5%, Vanguard. Raynet, the Luxembourg company, owns over 2%. Then you see a lot of big companies, UBS, Fidelity, Allen Gray, Franklin Resources, Pictet Asset Management, a British company, Royal London, HSBC, Hong Kong Shanghai Banking Corp, their UK division. Their employee count has gone down from 58,000 to 47,000, and the ticker trades on the OTC Pink Sheets, London Stock Exchange, Deutsche Börse, Zitra, Johannesburg in South Africa, BATS Europe, Mexican Bolsa, Bulgaria, New York Stock Exchange, Deutsche Börse, and the Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.